Hello, everyone, and thank you for joining us this month for Side by Side Digital. I'm your host, Rebecca Shively. We've got a great program lined up for you today. This month, we're talking about cost of production. As 2021 wraps up, you may be digging into some of your numbers to determine how the year went for you. Our experts today are here to walk us through how to use cost of production, not only to determine whether or not you made money, but how cost of production can be used to help make other decisions on your operation. Today, we're joined by Shayla Trundle, a financial services officer out of Central Iowa, and Betty Van Boning, a financial services officer out of Southwestern Nebraska. Shayla, Betty, thank you both for joining us. Shayla, why don't I turn it over to you and you can tell us a little bit more about yourself.
Hi, everyone. Thanks for joining us today, and thanks, Rebecca, for kicking us off. Like Rebecca said, my name is Shayla Trundle, and I am from Central Iowa. I have worked at Farm Credit Services of America for 9.5 years in different areas on the crop insurance team as well on the lending side. I grew up on a cow-calf operation in Northeast Iowa. We also row crop, and I'm still very involved with that operation of going out and helping on the weekends and running numbers and helping Dad throughout the week with other things that are going on from being a little bit more remote. So thanks for joining us. And Betty, go ahead and get us kicked off.
Hi, I'm Betty Van Boning, and I have been with Farm Credit Services of America for 40 years. I am looking to retire in December after a wonderful career with a wonderful organization. I grew up on a diverse operation. We had cow, calf, and feed and grain, and my husband and I purchased his family farm and have a small feed and grain operation as well. So that's a little bit about me. So let's talk about cost of production and why it matters. To start, I believe we have a little poll that's going to come up, and we're going to see how many of you actually calculate cost of production. 56% of you calculate your cost of production. Well, I will tell you that you are a step ahead of the other 44%, because how do you know when to sell? How do you know if you're profitable if you don't do your cost of production? So today we're going to put one more tool in your toolbox to help you in all of your management and marketing decisions. So why it matters? First of all, it matters because it helps you become more profitable. You know when you're profitable and when you're not. It takes the stress out of your operating decisions and allows you to make them with confidence. It sharpens your business acumen. Everybody's a great producer, but you got to know your figures. So it helps you clarify, improves your bottom line, and takes the emotion out. But who would know that knowing what the cost of 1 acre or 1 animal unit could do so much? So this next slide is probably the one that's going to give you the most information. We have data coming at us from all over today. The internet, neighbors, bankers, accountants. But this is a very powerful tool in putting that together for our own operations. So the break-even point shown on this slide, or what we call the tipping point, is when your profit covers your fixed expenses, your variable expenses, and your living expenses that are not covered by off-farm income. And we'll go more deeply into all of those as we go through the presentation. The more that you sell in that profit area, the more your profits are. But the other thing about this is, if you know where that break-even point is, and let's say you've sold 80% of your crop above and have a great profit, then if the price of corn, for instance, goes below that break-even point, you still know you'll be profitable because you had all the profit on the first end. So you'll know where you're at. So a solid cost of production gives you an accurate break-even or tipping point. Everything, of course, is not black and white, but we would like it to be. And cost of production will help you get there. It will help you decide when you should sell, when you should expand, when you should rotate a crop or upgrade. By knowing your cost of production, it empowers you to take the uncertainty out of your decisions and gives you more operational control. And if you have more time, you can do the things you want to do. So cost of production can help you draw that line in the sand. Are you profitable or not profitable? What should you do with your operation? After all, we all know that bottom line is everything. And with that, I'll let Shayla go.
So what is cost of production anyways? This is a big thing that you're going to hear from a lot of financial officers about helping you determine whether you're profitable, whether you should expand your operation, and what's going on. So today, you're probably already doing a balance sheet. A balance sheet is a list of your assets and liabilities as of today. It helps you determine your net worth. So you might be filling this out yourself, or your financial officer might be helping you. We're always around and we're here to help. A tax return, that's going to go through your year from January to December and show what your income and expenses have been. That's also very important. Probably one of the most important things is the cash flow. And we're going to tell you a little bit about why and what it is as we go on. But just know that the cash flow is very, very important. But not only is it important for your lender, but the most important person it is for is you. So we strongly encourage that you're completing all three of these every year, right after harvest or after the season of livestock. So looking at cost of production, it is the total expenses. Here we have predicted. We'll kind of walk through why we say predicted, and then we'll get into actuals, divided by your total number of units. That could be per acre, per sow, per cow, per sheep, whatever livestock or operation you have, whether it's corn or soybeans, wheat, all of those fun things. I'm going to take a minute and let you kind of soak in everything that is on this screen and kind of break it down for you. So looking across the top, we have last year, this year, and next year. So that follows the calendar year. Along the left-hand side, we have crop years. Last year's crop, this year's crop, and then next year's crop. So looking at this, when you're analyzing it and looking at all the numbers, the main question that we have for you is, did this operation make money or did they lose money? As we look down at this year, this is probably how most of your tax returns are done. I would say probably 95% taxes are done on a cash basis. So that is when they actually happen. So looking at this year, the beginning of the year, you probably sold some of last year's crop, paid some storage, finalized all those expenses, bought inputs for this year. At harvest, you sold some crop, and then now you're looking ahead to next year to buy prepaid expenses. So this is when the expenses were actually happened. Okay, so that's cash basis. If you look at it from this side of the operation lost $40,000. So again, that's most of your tax returns. If we take it a step further and look at the crop season, so we're going to look at from accrual basis. So taking that another step, we're going to look at this year's crop. So last year you bought prepaids. Then you also had some more inputs that you paid for this year. At harvest, you sold a portion of your crop. And then next year, taking it a step further, selling the remainder of your crop, and then also covering any final expenses such as storage. So looking at this way on an accrual basis, which is typically how the cash flow is calculated, the operation actually made $120,000. Well, I don't know about you, but when I take my tax return to my lender, it's going to say I lost money, but in all reality, looking from the cash flow perspective, I made money. So that's why most of these are very, very important, because I need to do my tax return for the government, but I also want to do the cash flow. So, hey, lender, I did make money and I want to prove that. Also, it helps for planning for next year on things that can change in my operation. Can I expand my operation? Do I need to sell grain at what time? There's a lot of things that goes into this. So some terms to understand, and we're going to kind of use throughout the document. So we have fixed cost, also known as overhead costs. So these are used interchangeably. These are costs that do not fluctuate no matter how many acres or how many head of livestock I have. So for instance, my machinery payments, right? No matter how many acres I farm, I'm still going to have those payments. Variable costs. These do fluctuate based on the number of acres and head that I have. So seed, chemical, fertilizer, fuel, crop insurance, all of those things are changing and they're variable costs. One of the most important things, and a lot of people forget, is family living expenses. So looking at this, typically when we look at an operation, we say if there's any off-farm income, we check to see if family living can be covered by the off-farm income. If it can, great. If not, that's okay. We take and look at whatever is not covered by off-farm income, and we also have to calculate that into the operation so that it is covered, because we have to pull money from somewhere to put food on the table and shelter over our heads. And then some operations don't have any off-farm income. Again, that's okay. We just have to remember to add that into our bottom line, because it can make a huge impact on our numbers. All of these are known as our total cost. So again, going back to what cost of production is the total expenses divided by the number of units. A couple slides ago, we talked about predicted. Okay, so typically the time of year that we want to work on a cost of production is right now, right? So we are pre-planning for next year's crop season. Okay, we're talking to our seed rep, our chemical rep, our fertilizer rep, all of that stuff. So we're probably getting quotes of how much do I think it's going to cost. So that's why we're considering it predicted, because we're doing it now as an idea of what we are going to plan or need to pay. As time goes on, we'll find out that we'll want to update this throughout the year to figure out what our actual expenses are. So both are important, predicted and actual, and we'll learn more about that in a little bit. Taking that a step further, once we have figured out what our total cost of production is, we can divide that by the amount that we have produced. Okay, so for instance, if we are a corn and soybean operation, we'll take the cost of production divided by how many acres, and then we can take it one step further, divided by how many bushels we're going to potentially and hopefully produce to figure out our break even. Just going back to that equation and looking at that graph that Betty talked about our tipping point on the break even scale.
So now we need to show you how you calculate this. So the calculation is actually a 4-step process. We have to gather the information, allocate the expenses, we'll run the numbers, and then we'll evolve the process. But as Shayla said, it's not necessarily a one-time process. It's something that you can update as you go along. Also remember that all of this information, the break-evens, the cost of production, they vary from operation to operation. Don't ask your neighbor what theirs is, because it's going to be different than yours. Maybe he doesn't have the land payments or the equipment payments. So when we start looking at gathering information, first of all, we're going to go to the historical information. And your tax returns, your income statements, what have you been spending on these? What are you going to have to change in the future? You know, what are your production income going to be this year? It was 5 something we could sell corn for this year. Last year it was 3. If you're forward looking at your expenses, you better add a little to that fertilizer and seed for next year that we haven't had to add before. So look very carefully at what you do. But gathering information isn't a one-time thing either. I could put in that my living expense is $40,000 today, and you know, maybe I'm going to add to my family and it's going to be $60,000 before the end of the year. Or I don't know what I'm going to spend on my fertilizer. I can only estimate it, and then I can go in and put the real number in later. So continually update. But when you're doing this, know that the better the information going in, the better the decisions coming out of this. Also know that the following are the most missed. Your prepaids, don't forget them just because you did them in another year. Repairs, maintenance, supplies. Make them as realistic as you can because it affects the bottom line. Operating interest, overall farm insurance, and hired labor are also very often missed. So then we have to figure out how to allocate them. And you have to know your line items before you can allocate them. Crop 1 may be corn, crop 2 may be beans, but you need to include everything. And if there's one thing I can't stress enough is be careful that you don't leave out the small expenses, because one of the biggest expense or biggest mistakes is that small and small and small all becomes a big mistake. And so we want to make sure we do that. The other thing is, once again, the information is only as good as what you put in. Now, when you're doing this allocating, I'm going to tell you that you need to go to the farmer out in the field to really get the right allocations. So my husband thought that I was going to do this for him on our farm. And I said, no, I don't know what you put on the irrigated for fertilizer, and I don't know what you put on the dry land for fertilizer. You have to do this. Well, after 3 years, he finally did it, and he's really happy he did. But it's one of those things like, if all the fungicide went on the beans, then I can allocate that bill all to beans. But my tractor repairs, I may have to do on percentages. Maybe I have 300 acres of soybeans and 700 acres of corn. So that's 1,000 acres. So 30% of the repairs will go to beans and 70% will go to corn. Or it could be on your living expenses. You're going to allocate them straight across the board for every acre. A lot of that will also depend upon if you have a breakdown of irrigated and dryland acres. We all know dryland is not as profitable. So maybe you're going to say, you know what, my irrigated is going to have to take care of more of my living than my dryland. Other ways that you can allocate it is based upon the gross income that they're going to produce to your operation. If one is going to produce $1 million and the other one's going to only produce 500,000, then maybe you want to allocate them 1/3 and 2/3. You have to do what works for your operation. So we're going to look at how you do this on a grain operation. So the math works by you take your total expenses and you divide it by your units or acres here to get your cost of production. And why do we use acres? Well, because we're going to go back to that predicted statement. We don't know how many bushels we're going to get, but we know how many acres we're going to plant. So our acres or our head level is what we always know up front, and they're the most stable unit. So that's why we use those to make our decisions. So then you take your cost of production and you divide it by your predicted production and you get your break-even point. Now you want that predicted production or amount of production to be as realistic as you can, because it definitely is going to affect your break-even point, just like your total expenses will. So as the bottom of the screen says, the unit is where the production decisions matter. So just remember that as you go forward. The same applies to livestock. Once again, we take your total expenses and divide it by the number of head. We don't go out and say how many pounds of livestock you got out in the pasture. We say how many head do you have. So the tipping point again is going to fluctuate with the number of pounds, but we don't know that always till the end of the year when we go market our cattle. You know, if there's lots of grass, you would think those would be little fat animals, and usually they're going to put on less pounds. So use your predicted to get your break even, but there again, based on the year, you can change your figures. Once again, the cost of production does not change, but your break even point will fluctuate.
So how do we use it? Let's put it into play. Now we're going to have you put your thinking hats on. So the question on this screen is to contract or not to contract. So we've done a lot of calculations here already for you. So we're just going to kind of break it down to take a look at it. So we have 20 head of cattle at 602.5 pounds. Our total production is 12,050 pounds. We've already listed our variable cost, our overhead or fixed cost. We have our debt out there for machinery payments or any other loans associated with this. To figure out our total expenses is $18,586.86. We take that number and we divide it by the 20th head of cattle that we have to figure out our cost of production of $929.34. Divide that by our 602.5 pounds, as Betty was saying, to get our break even of $1.54 a pound. Our contract price today is $1.45. Okay, so break even is $1.54 and our contract price is $1.45. Our question to you on the screen is, are you going to contract your cattle at $1.45, or are you going to hold off and wait till later? All right, so 9% of you say yes, we're going to contract. No is 82%, and I'm not sure 9%. Well, to be honest, all of those might be right. So the majority of you said no, and I agree. So why would we want to go out and sell our cattle for $1.45 if we need $1.54 to make money? So kind of the no-brainer is no, we don't want to. But some of you that said yes, that might be a good option too, because maybe the predicted market is that the market is going to go down. So this may be the highest you're going to be able to sell for the year. It's definitely a tough decision, and marketing is one of the tougher things that you're going to have to do in your operation. So if I take it back and I look at it, changing and losing money is only going to be like a little over $1,000 on these head of cattle. So again, I have to make the decision of, do I want to lose a little over $1,000 and hope that the market doesn't change much, or do I want to hold out and see and hope the market doesn't go down even more? Our next exercise is, are we going to rent 85 acres or are we not going to? Okay, another local landlord came and asked if we would be willing to pay $300 to rent another 85 acres. Breaking the slide down again, our rent on that is $25,500. We're anticipating about 200 bushels per acre. Our variable costs are $655 an acre. Our overhead or fixed costs are $38. Our debt service is $48. So we have our total anticipated cost of production to be $1,042.44 an acre. Calculating that back and dividing by our 200 bushels that we are anticipating that we're going to produce, our break-even price is $5.21. Today, we can contract our grain for $4. So looking ahead and planning ahead of what do we think the market's going to do between now and when we would harvest, we're going to ask ourselves, do we want to rent this extra 85 acres at $300, or are we going to pass? So go ahead and think about that and answer the question on the screen. All right, 9 of you said yes, you would rent it. 82% said no, and 9% said I'm not sure. Again, all great answers, right? So we're going to break it down, and if we say yes, we are going to rent the ground, Well, looking at that, we are going to lose in this market $1.21 a bushel. Take that back times your 200 bushels per acre and your 85 acres. You're setting yourself up right now to lose $20,570. Is that something that the operation can absorb or withhold to be able to continue to move forward? There was also a response that said, no, I do not want to lose that much money on that piece of ground to rent it for $300 per acre. If you take a look at it, I know farming is a big thing and there's a lot of emotions that are running wild. And let me tell you, as a financial officer, we hear all of them, right? Well, if I don't rent it today, I might not have an opportunity to ever rent it again in the future. Well, I might just lose money this year, but I might make money in the few years after that. Well, how close is this to your operation? Maybe it's the farm next door, or maybe it's 15, 7, 10 miles away, and what do you do? So there's a lot of teeter-tottering factors that are going to play into the scenarios that you have to run through your mind. And without running these numbers, you wouldn't have known, right? So when we compare both of these options, I don't know about you, but I'd rather lose the $1,000 on the cattle than lose $20,000 on renting these acres. But without running these calculations, I wouldn't have known that. So it's very, very important for you to calculate these numbers because they're going to help you in your operation. And there's a lot of things that go into it. So don't worry, your lender is always going to be willing to help you walk through it. The most important thing that I want to say, and like Betty mentioned, was the information that you put into it is what you're going to get out of it. So your lender isn't going to have all of these numbers figured out for you. You're going to have to do some homework and research because every operation is different. So doing it together with your loan officer can be helpful, but you're also going to need to do some research beforehand. So again, back to your everyday decisions. Do you contract when and where? And do you continue to grow your operation now or later? Here's a few quick reminders that are very important. First off, check your math, okay? Make sure that you didn't transpose a number or add an extra zero. Other things are look for decimal places in the wrong spot. Maybe I was typing it in fast or wrote it down wrong. Also making sure that your columns add up. Whether you're hand calculating it with the calculator, maybe you put it into Excel or another document, make sure that it's flowing right and makes sense. And watch out for missing and inaccurate information. This can make a huge difference on your bottom line. For example, some things that are really underestimated. Family living. Not only do I talk about the food on your table and the house over your head, but also those vacations that you do, the donations that you make, gifts that you buy throughout the year. There's a lot of things that, man, you just don't even think about. You're spending cash for, or did it, 12 months ago and you don't remember. So making sure to keep those in mind throughout the year is very important. Repairs are also underestimated. Labor. I don't know how much it's going to cost, but I try to plan ahead. Maybe things come up. Freight, storage, travel cost, custom hire, all of that. So as we said, when you're doing your predictions, make sure that you have those numbers, but as the year goes on, update that so then you know truly where you're at after you purchase your fertilizer, after you pay your labor, all of that fun stuff. Some things that we find are overestimated are repairs and services, because you might not know what's to come or not to come throughout the year. Evolve your process. We put a lot on your plate today talking about cash flows and cost of productions and calculating your break-evens. This isn't something that's done overnight, right? It's a process. So you want to start early, kind of get the predicted, get that going, and then pick it up another 1, 2, 3 times a year, or maybe some people do it as a full living document. So they're constantly changing it every time they buy something, every time they sell ground or sell bushels, they look at where things are every time the operation changes. How detailed do you want to be? So today, maybe you don't do it at all. And this year you just look at corn, or you just look at soybeans, or maybe you're just looking at this pen of cattle. There's different things. And then maybe you're already doing that. So I'm going to challenge you to get to the next level, and maybe you do it by field. Farm 1, farm 2, farm 3. How does that break out and differ? Because honestly, your APHs are going to be different. You know, the quality of the soil is different. You're going to be able to produce different things. So maybe you need to put more fertilizer on this piece and less fertilizer on this piece because you did some soil sampling this year. So a lot of different things play into it, so you can make it as detailed as possible. And then again, like we said, break it down to field, pen, all of that. So what you put into it is what you're going to get out of it. But I can guarantee you that if you sit down and you work on this by yourself and or with your loan officer, you are going to be miles ahead of all of your neighbors in helping out. I'm just like you, and I know Betty and I have talked and had the same conversation, is we'd rather be out in the field or out in the cattle lot doing things and getting our hands dirty, but we cannot stress how important this financial piece to helping your management set you apart from other people is going to make you grow and grow your operation as time goes on. So very, very important. Kind of to recap, we want to make a plan, right? So we're going to sit down now. We're trying to plan what next year is going to look at. Tap into those resources. Call your seed rep, call the fertilizer, call the co-op, see what you can look at the markets and what you can sell for. So go ahead and do all that extra homework to pre-plan to see where things are at. Be as specific and detailed as possible, right? So put down all of your chemicals. Maybe you don't just lump them all together. Maybe you put every item down, okay? And just keep doing that for every livestock head, every expense that you have, where it's at. So then that way, when you come back and look at it later, oh yeah, I forgot. We had to do a major overhaul on this tractor this year because next year we probably won't have that, but maybe something else will come up. So that gives us an idea. Use your tools and technology. A big thing at Farm Credit, we look at trends. So we'll put in your financials, we'll put in your tax returns, we'll look at everything of how things have shown in the past. So maybe I don't quite know what I usually spend on repairs, and obviously it fluctuates every year, but call up your loan officer because they can look and see, okay, over the last 3 years, what have my repairs been? That gives me a 3-year average of, hey, this is possibly what I could spend. Go online, look at all that information, get marketing information through different avenues and all of that. Gather as you go. Yes, this seems like a lot, and yes, it is. And planning and making it set ahead of time is very, very important. But you can do it in different chunks. You don't have to sit down all in one day and do this, right? So a rain day comes up, do a portion then. Have a few hours later, another day, do it then. Kind of do that. And then again, just increase your frequency. If you're not doing it today, start at a low level. If you're doing it today, take it to the next level and get it as in-depth as you can, because this is the most important thing that you can do to set yourself apart. Well, we want to thank you so much for joining us today. We have been happy to help you. Farm Credit Services America really appreciates everything that you guys do for us. You're just as important as we are to each other. So we also want you to reach out to your loan officer, and don't be afraid to ask for help, because that is what we're here for. Rebecca, do we have any questions?
Yeah, thank you, Betty and Shayla. We do have some questions that have been coming through here. First one, and I'd love to hear both your takes on this one. This person would be interested to hear how you suggest allocating overheads between or across enterprises to get a net cost of production. So management costs, office machinery shared between crop and livestock, for example.
Well, I think first of all, I would go to your gross income. So what's your gross income on your crops and what's your gross income on your livestock? And use percentages accordingly. Not all of your equipment will be used for the livestock. So maybe then, so let's say you have a 70-30 split, but I don't use all my equipment for my livestock, or maybe you do if you grow your own feed. So start with 70-30 and maybe you need to decrease it to 80-20. You kind of have to see what works and what you feel comfortable with. And I know today that we have dummied this all down because we've taken them, you're only a grain farmer or you're only a livestock farmer, but gross income actually probably works the best in splitting it up.
I agree with Betty on looking at percentages of income or how large one side of your operation is compared to another. Another good thing to think about is, okay, time. If I sit down and I think about how much time I'm doing management decisions and thinking throughout a week's time frame, how much am I allocating to the grain side versus how much am I allocating to the livestock side? Obviously, throughout the year, your seasons are going to change. So spring and fall, you're probably focused a lot on the grain side, but maybe you're a cattle producer and you're calving in the spring and then you're breeding in the fall and all of that. So how it falls is kind of the same, but just kind of thinking about how much time is actually spent and allocated to those operations can be very helpful. If you don't have a starting point and you say, well, I don't know if it's 70-30, splitting it 50-50 is a good place to start, and then adjusting the numbers as you need to go. Obviously, you don't want to adjust them to fluff them to make them look better, but you want to be realistic to where things are falling.
And the big thing is, look at your cash flow. Your cash flow and your costs are what are going to be behind all of this. So the first thing you have to do is split your costs out between your crop and your livestock, your variable costs, before you really go to your overhead. And you may find that when you start getting your tipping points or your break evens, that maybe then that will also show you, well, this is way out of line and you need to adjust accordingly.
Great. Another question, maybe kind of I can combine two of these. One, I noticed on the slides, it looks like you're just using Excel to work through that. Do you have any suggestions for templates or something that people can use to get started? And the second part, can you give us a detailed list, examples of variable and fixed costs so someone can assign them to the correct category?
You guys are in luck. We do have a few different lists. So contacting your financial officer, they have a cash flow statement that can be used. Most of that one, we're probably going to look at an operation altogether. So no matter what enterprises you have, but you can also take that document and break it out per. So maybe I have corn and soybeans and I have cattle. Maybe I do two of them instead of just one of them together. Another thing is today, after our call, we are going to be emailing out a copy of the presentation that we're recording right now, but also there will be a list of different items in there, with family living, variable cost, overhead costs, that will be a very good guide for you guys to use. Every operation is different. So maybe there's some things that you use that somebody else doesn't use. Just make sure you remember to add those in. If you hire a CPA, we have professional fees in there. Make sure that's added in. If you subscribe to any magazines or anything like that for marketing use, add that in. So don't be afraid to kind of go off of what we have, but then add to it. So spin it off to what you need. And then again, maybe there's some things that we have on there that you don't specifically need to use. That's totally fine. Don't feel like, oh my gosh, I need to start doing that. You don't have to. This is just a guide to go off of.
And there's lots of resources on the internet available, or your financial officer. Farm Credit has lots of cash flow forms that break out variable and overhead costs as well. And like Shayla said, you will be getting the cost of production forms that we've put together at the end of today. But I'm sure they're out there on the internet as well. Gather all your resources.
Great, lots of great resources out there, and really handy that your financial officer is a good resource for some of those as well. Another question here, if my off-farm income covers my family living, why should I include that in my cost of production? I'm trying to keep farm expenses and income completely separate from personal.
You wouldn't. If your non-farm income covers all of your family living, then you don't need to add it into this. However, make very sure that it covers all of that family living. And in one of the forms that we're going to send out after this presentation, it will go through what's all included in family living, because it is one of the most underestimated expenses out there. So if you know that it covers everything, that's great, but you may find that you still want to rely on the farm income for some of it.
All right, another question that came through. We have a cow-calf operation that sells backgrounded feeder calves and finished locker beef, as well as hay. Do you typically break out each enterprise, or do you look at the farm completely as a whole?
So you can do it both ways. We would encourage you to break it out per enterprise, just because that is going to be the most accurate information and be the most beneficial for you to make decisions. So if you look at it as a whole, the operation could be making money. Great, awesome. And then all of a sudden we break it out on your backgrounding cattle, your cattle that are going to the locker, and then also looking at your haying side, all of a sudden we see, oh shoot, you know, the haying business is bringing us in a lot of income, but the background in cattle isn't really bringing us any income. It's actually losing us money. So that can help you make decisions in the future of, one, how do we need to make changes to our operation of, you know, decreasing expenses, bringing in more income, or do we just maybe need to exit that enterprise altogether? And I'm not saying one or the other, it depends on what your numbers look like, but you definitely want to break it down per enterprise to see how is each enterprise doing to be able to make up our whole.
Absolutely. And the other thing to remember is it will change year to year. I mean, you may make a lot of money selling your processed beef and not so much background in cattle this year. The next year it could flip-flop. So that's why if you do this over time and you look at it annually and compare it to the past, you'll have a much better idea of the enterprises you should stay in and the things that you should get out of.
Farm Credit is really big at looking at trends. So typically when we start a new loan, we'll look at 3 years of tax returns. When we look at balance sheets, every year we do a balance sheet, we'll look at, has the operation made or lost money? You know, a lot of those we see 2 to 3 to 4 year trends to help us make decisions. So just like Betty said, it's not a one and done kind of thing. It's how have things progressed year after year, which is very important for you guys to look at it that way too, is over years, how has everything looked?
Great, really good advice there. We are just about out of time here. So I do want to make sure that we end on time and wrap up a little bit. The other thing that I'll throw out is we're actually really interested in digging into cost of production. We actually have a research study that's going on with some of our folks here at Farm Credit, trying to learn a little bit more about how our customers use cost of production. So in the follow-up, in addition to the presentation and those forms that Betty and Shayla mentioned, we'll have a little bit of information about that. If you're interested in participating in a research interview, there's some compensation involved. So it's kind of a fun way to make sure that your voice is heard and give some feedback to Farm Credit. So I do want to thank Betty and Shayla for being here today, sharing their expertise. Again, a lot of information to soak in, but a really great thing to be thinking about as we're headed into the end of the year here. So we'll be back next month and actually next year on January 5th. We'll actually be building on cost of production and how you can use it in some of your crop insurance decisions coming up. So if you thought today was interesting, definitely join us again on January 5th. Until then, take good care and have happy holidays, and we'll hope to see you online soon.